We kick off today's coverage with a notable analyst call that is sending ripples through the industrial space. JPMorgan has issued a price target cut on SUNL, Sunbelt rentals, citing deteriorating margin expectations in the equipment rental sector. This isn't a routine trim. It reflects a more structural concern about competitive pricing dynamics and cost inflation compressing profitability at one of North America's largest equipment rental platforms. With the industrials ETF already navigating a choppy macro backdrop and the VIX sitting at 19.24, this call lands at a sensitive moment for cyclical investors watching whether CAPEX momentum is genuinely holding or quietly rolling over. JPMorgan's analyst team formally cut their price target on SUNL, Sunbelt rentals, pointing directly to margin pressure as the primary driver of the revision. The concern centers on two compounding forces: competitive pricing dynamics that are limiting Sunbelt's ability to push through rate increases, and cost inflation that is eroding the operational leverage the business historically relied upon. Equipment rental companies like Sunbelt have historically operated with EBITDA margins at elevated levels, and Wall Street models had assumed stable to expanding profitability. JPMorgan's cut signals that consensus estimates across the sector may be too optimistic and could face meaningful downward revision in coming quarters. The deeper significance of this call goes well beyond one company's earnings model. Equipment rental demand is a real-time barometer of industrial and construction activity. When contractors, event organizers, and infrastructure operators pull back on renting heavy machinery, it signals genuine hesitation in forward capital deployment. JPMorgan's cut suggests that the rental pricing environment has softened enough to offset volume, which is precisely the kind of inflection point that precedes broader CAPEX cycle deceleration. The 10-year Treasury yield at 4.43%, while down slightly today, remains at levels that elevate hurdle rates for capital-intensive projects, making equipment rental customers more cost-conscious and less willing to absorb price hikes from rental providers like Sunbelt. The most direct exposure sits in SUNL itself, but the read-across hits United Rentals, which competes in the same equipment rental market and faces identical pricing and cost dynamics. The industrials ETF carries broad sensitivity to this narrative, as rental utilization trends correlate tightly with construction and manufacturing activity across its holdings. Downstream equipment manufacturers also face indirect risk. If rental fleet utilization softens, Sunbelt and peers reduce new fleet purchases, pressuring order books. On the macro side, the Russell 2000 ETF reflects how small-cap industrials and equipment-adjacent names are already struggling to generate meaningful upside in this environment despite the broader market staying afloat. The most critical near-term catalyst is Sunbelt's next earnings report, where investors will scrutinize fleet utilization rates and rental rate per unit. Those two metrics will either validate JPMorgan's margin concern or provide relief. If utilization is trending below seasonal norms, the market will reprice the entire rental peer group lower. On the macro side, watch the 10-year yield at 4.43% closely. Further compression would ease cost of capital pressure for rental-dependent industries and provide some offset. The VIX at 19.24 suggests options markets are pricing moderate but not extreme risk, meaning a negative utilization surprise from SUNL or United Rentals could trigger an outsized derating. Also monitor industrials for any technical breakdown that confirms institutional rotation away from cyclicals. JPMorgan's price target cut on SUNL is more than a single stock call. It is a disciplined warning that the equipment rental sector's margin story is cracking under the dual weight of competitive pricing and cost inflation, and that consensus EBITDA expectations across the peer group may be too high. Investors with exposure to United Rentals, industrials, or any construction-adjacent industrial name should be actively stress-testing their margin assumptions and monitoring utilization trends rather than waiting for a formal earnings miss to act. Positioning in defensive sectors and monitoring capital allocation patterns across the CAPEX cycle will be key to navigating what could be a broader industrial deceleration. That's the full picture on the JPMorgan Sunbelt call today. Coming up next, another story with significant implications for how markets are pricing risk right now. Shifting now from macro to a story about the architecture of modern markets themselves. Cboe Global Markets, the company that owns the VIX Volatility Index currently sitting at 19.24, has officially launched its first prediction markets products. This is not a minor product extension. Cboe is deliberately repositioning itself to capture a fast-growing, high-engagement category that has expanded more than 40% year-over-year in retail participation. The move comes as the exchange operator looks to diversify revenue beyond its flagship equity derivatives business and build on the explosive momentum it generated from zero-day options growth. This is a significant strategic inflection point for one of the most important infrastructure companies in global finance. Cboe Global Markets has launched its inaugural prediction markets platform, marking the company's first foray into event-based contract trading outside its traditional derivatives and volatility product suite. The launch is designed to capitalize on surging demand from both retail and institutional participants who want structured, exchange-grade access to prediction market instruments. Cboe brings to this space something pure-play platforms like Polymarket cannot easily replicate: regulatory credibility, institutional-grade clearing infrastructure, and an existing base of professional traders already familiar with volatility-linked products. The VIX, Cboe's most iconic product, is trading at 19.24 today, down 1.28%, reflecting a relatively calm backdrop that is broadly supportive of risk-on, speculative positioning across newer asset classes. The real driver here is not just product diversification. It is Cboe's recognition that the behavioral profile of modern retail traders has fundamentally changed. Zero-day options exploded in popularity because traders wanted short-duration, high-conviction, event-based exposure. Prediction markets are the natural next step in that same demand curve. Cboe is essentially reading its own user data and concluding that event-based probabilistic contracts are where incremental volume growth lies. The broader macro backdrop reinforces this, with the 10-year Treasury yield at 4.43% and the S&P 500 near 7,348. Cash yields are still competitive, meaning exchanges must innovate to attract speculative capital rather than simply riding a zero-rate bull market. Prediction markets offer a genuinely differentiated engagement layer. The most directly affected name is Cboe Global Markets itself, which should be monitored for early adoption metrics and trading volume disclosures from the new platform. If user acquisition accelerates, the market will begin repricing Cboe Global Markets on a fintech-style revenue multiple rather than a purely traditional exchange multiple. That re-rating could be meaningful. Competitor exchange operators CME and Intercontinental Exchange are also in frame here. A successful Cboe prediction markets launch raises pressure on both to respond with their own event contract offerings or risk ceding a high-margin, high-engagement revenue line. On the index side, the Nasdaq 100 is down 3.29% today, reflecting broad profit-taking in growth and fintech-adjacent names, which creates a potentially attractive entry context for investors with a thesis on Cboe Global Markets' new vertical. The most important near-term catalyst is Cboe's initial adoption data, user registration volume, trading activity, and any early revenue guidance tied to the prediction markets platform. Watch for management commentary and upcoming earnings calls explicitly quantifying the addressable user base and margin profile of these new products. On the regulatory front, prediction markets occupy nuanced legal territory in the United States, and any enforcement action or CFTC commentary could become a meaningful headwind. Technically, keep the VIX at 19.24 in view. A sustained move lower would support risk appetite and benefit speculative platform engagement. The 10-year yield at 4.43% is also a backdrop variable. Further yield compression would redirect capital toward growth-oriented exchange plays, including Cboe Global Markets, over the next 2 to 3 quarters. Cboe's entry into prediction markets is one of the most structurally interesting exchange sector developments in recent memory because it signals that traditional derivatives infrastructure operators are willing to compete directly with emerging fintech platforms on their own turf. The zero-day options playbook proved Cboe can successfully court retail engagement without sacrificing institutional credibility, and prediction markets are the next iteration of that strategy. With the Nasdaq 100 under pressure at a 3.29% decline today and broader fintech names seeing profit-taking, any near-term weakness in Cboe Global Markets tied to macro noise rather than adoption fundamentals could represent a compelling opportunity. Those are the two stories that matter most today. Full breakdown is up and ready for you. If this kind of deep dive market analysis is what you need to stay ahead, hit subscribe right now and turn on the notification bell so you never miss a daily breakdown. Every trading day we cut through the noise and give you the specific numbers, tickers, and catalysts that actually move your portfolio. Subscribe now. The next video is already in production.